Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
21 million barrels. That's basically 20% of global daily petroleum consumption. If that gets pinched, you aren't just talking about a minor spike at the gas pump. You are talking about a structural rewiring of the entire global energy market.
Exactly. And here is where the institutional disconnect drives me absolutely crazy. If there is a physical blockade or a hot kinetic conflict in that strait, that oil simply does not move. It is physically off the market. Yet you have central bankers and academic economists sitting in Washington thinking they can adjust interest rates to fix this. Let me be as blunt as possible. Monetary policy is utterly powerless to print a single physical barrel of crude oil.
Right. Chairman Warsh can't exactly dial up the federal funds rate and magically manifest a fleet of super tankers to bypass the Persian Gulf. It's a physical supply bottleneck, not a demand-driven credit expansion.
And that brings us to the ghost that still haunts the halls of the Eccles building. Though most current policymakers seem to have forgotten the lesson, I am talking about Arthur Burns in 1974. When the OPEC oil embargo hit in late 1973, it was a massive non-monetary supply shock. What did Burns do? He looked at the skyrocketing CPI numbers, panicked, and hiked interest rates aggressively, directly into a physical supply shortage.
Which was a disaster. He tried to cure a physical shortage of oil by making capital more expensive for businesses that were already reeling from high energy costs. It did absolutely nothing to bring more oil to market. Instead, it just crushed real economic output and accelerated us straight into a brutal stagflationary spiral.
It was a devastating policy error. Burns treated a supply-side shock as if it were an overheating demand-driven credit bubble. By killing aggregate demand while the supply curve was structurally broken, he managed to get the worst of both worlds, high inflation and high unemployment. And my deep concern today is that Fed Chair Kevin Warsh is setting up to play the exact same deeply flawed hand if we see another geopolitical energy shock.
Well, let's break down the actual mechanics of that, because there is a massive difference between supply disruption inflation and demand-driven wage push inflation. Think about a local bakery here in Reno. If the price of wheat spikes because of global crop shortages and the utility company doubles their commercial electricity rates, that bakery's input costs have surged. That is a supply side shock. It has absolutely nothing to do with their workers demanding higher wages.
And if the Fed raises interest rates to, quote, cool the economy in that scenario, what happens to our Reno bakery? They can't magically make wheat cheaper or lower the utility bill, but suddenly their line of credit is more expensive. Their customers have less disposable income, and their margins are completely obliterated. The Fed doesn't solve the structural wheat or energy shortage. They just force the bakery to close its doors.
Right. You are trying to use a blunt macroeconomic hammer to fix a highly localized structural supply chain micro problem. It's a fundamental mismatch of tool and task.
It is, but Fed Chair Kevin Warsh has a very specific hard money doctrine. Warsh has always been deeply skeptical of quantitative easing and balance sheet expansion. He has historically favored rapid normalization of interest rates. In his mind, keeping rates higher for longer is the only way to maintain the Fed's inflation-fighting credibility, regardless of the underlying cause of the inflation.
So if you are an investor sitting there waiting for Chairman Warsh to pivot and save the markets with easy money at the first sign of trouble, you are playing a very dangerous game. This hawkish Fed threat is real. They are committed to their models, and those models tell them that high interest rates are the cure-all for elevated CPI.
Which brings us to the glaring disconnect in the actual data. We recently saw a highly disappointing 1.6% annualized GDP print. That is a massive slowdown from what the Fed's aggressive growth models were predicting. The central bank's models consistently lag behind real-time economic turning points because they rely on smooth, lagging historical data. They are driving the car looking almost entirely through the rearview mirror.
And that means they are actively tightening policy or keeping it highly restrictive directly into a real-world economic slowdown. By the time their models finally register that the economy has decelerated to a crawl, the damage is already done.
Exactly. Just look at the NFIB Small Business Optimism Index, which recently hit a 10-year low. These aren't Wall Street analysts. These are real-world operators. And what are they dealing with? Skyrocketing diesel fuel costs. Diesel is the literal lifeblood of physical distribution and agriculture. When diesel prices spike, it drives up the transportation cost of every single physical item in the country.
You can't ship lettuce or lumber over Zoom. If diesel costs stay high, small business margins get squeezed to the bone. And eventually, that exhaustion of purchasing power flows directly to the consumer.
Now, to be clear, I don't think we are looking at a systemic 2008 style financial collapse. The current credit stress is highly surgical and localized. Large corporate balance sheets are largely insulated because they locked in historically low fixed rate debt back in 2020 and 2021. The pain is concentrated in specific vulnerable pockets like commercial real estate and regional banking.
But the risk is that these localized credit fractures begin to spill over. If a regional bank is taking heavy losses on commercial real estate loans, they are going to aggressively tighten credit standards for local small businesses. So even if it starts as a surgical problem, it can quickly turn into a broad credit squeeze for the real economy.
And we are already seeing the consumer side of that stress. Look at subprime auto asset-backed security delinquencies, which have surged to an unprecedented 6.9%. That is a massive red flag. Think about the psychological reality of an auto loan default. For most working people, their car is their lifeline. It is how they get to work, how they earn a living. It is the absolute last line of consumer defense.
Right. You will stop paying your credit cards. You will even stop paying your mortgage before you let them repossess the car you need to get to your job. If we are seeing 6.9% delinquency rates in subprime auto ABS, it tells you that the lower end of the income spectrum is experiencing complete household balance sheet exhaustion. This is exactly why we rely on our systematic, rules-based dashboard at Universal Value Advisors. When you have this much noise in the headlines and this much macro uncertainty, you cannot afford to invest based on gut feelings or emotions. We strip out the media bias and look strictly at objective, structural indicators like credit spreads and systematic flow indicators to guide our asset allocation.
It is the only disciplined way to navigate this. You have to tune out the noise and let the hard data dictate your risk exposure.
So, what does the dashboard tell us to do right now? One of our primary strategic moves has been extending duration in US Treasuries. With the economy slowing down and real GDP at 1.6%, locking in those attractive, long-term, risk-free yields is an incredibly valuable proposition for a portfolio.
Yes, when growth slows and the real-world economic pain mounts, those high-quality guaranteed yields become highly sought after. It is a classic defensive anchor.
But we also have to recognize the structural inflation threat from these potential supply shocks. That is why we are constructing a resilient barbell portfolio. On one side, we have those long-term treasuries, and on the other, we are hedging with treasury inflation protected securities, TIPS, and real assets like commodity equities.
That barbell approach is critical. It protects your purchasing power against persistent supply-side energy shocks, while still giving you the defensive benefit of high-quality duration if the economy decelerates faster than expected.
Of course, a disciplined, rules-based approach means we must always have clear falsification metrics. We have to know exactly what economic milestones would prove our current thesis wrong and force us to change course.
Absolutely. If we see a sudden surge in private sector capital expenditure, a sustained spike in labor productivity, or a significant narrowing of regional credit spreads, that would tell us the economy is finding a structural footing despite the restrictive monetary policy. Until then, we stay disciplined, protect capital, and respect the data. That's all the time we have for today. We'll see you next time.
Thanks, everyone.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late-cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member of our team, Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.